Hi, my name is Hillary Sunderland, and I'm the Chief Investment Officer of Beacon Wealth Consultants. And this is your March 2020 market update. Well, it's certainly been a tumultuous start to 2020. Just months ago, we were optimistic that the global economy would stage a modest rebound. The US and China had appeared to make progress on a trade agreement. The European Union and the UK finally agreed to go their separate ways. And central banks around the world looked poised to keep interest rates steady for the foreseeable future, adding further support to the equity markets. And then the coronavirus pandemic hit. And while many people thought that the virus would primarily affect China, unfortunately they were wrong. COVID-19 dealt a stunning blow to the market by becoming a force that brought businesses to a virtual standstill around the world. In March, more than half of US businesses and a third of the global population were under some form of lockdown, which sent economies grinding to a halt. And this was an event that was not anticipated heading into 2020. The subsequent selling in the equity markets and the bond markets was indiscriminate. Investors scrambled to flee both stocks and bonds as cracks began forming in the global economic outlook. The Federal Reserve, which is our central bank, acted very swiftly, slashing interest rates in an emergency rate cut on March 3rd, and that kept markets stable for about 2 days, and then the bottom really fell out in the markets. And the longest ever bull market in history ended very abruptly, with declines so sharp that it turned out to be the fastest bear market in history, occurring in only 16 trading days. By the March 23rd low, which is the most recent low we've seen during this bear market, the S&P 500 fell as much as 33.9% below its all-time high reached just recently in mid-February of this year. And it's been the largest peak-to-trough decline since the financial crisis. So what does this all look like in numbers? Well, all major equity indices were down approximately 20 to 30%, with domestic small cap stocks, which is the red bar there, getting hit the hardest, down 30.61%. Commodities dropped 23.29% as the price of oil plummeted, while investment-grade domestic bonds managed gains of 3.15%. And unfortunately, stocks weren't the only asset class facing record volatility in March. Usually tame fixed income securities also swung around violently. So the 10-year Treasury bond yield, which is arguably the most important fixed income benchmark in the entire world, entered March at a yield of 1.15%, which is already a record low. And if you were to pull up fixed income and bond yields today, which is what this chart shows, you can see here that the US Treasury, the 10-year yield, is now down to 0.56%. So yes, you'd be buying a bond, holding it for 10 years to earn a yield of 0.56%, something that was unthinkable just a few weeks ago. If you want to buy a treasury with a 30-year maturity, which is clear on the right side of that yellow box, you will receive a whopping 1.23% yield. So while this yield chart is very sobering, especially for people who rely on income to support their lifestyles, retirees, but also savers trying to earn some form of money in savings accounts, the interesting thing here is that we should actually be thankful for these yields, because if you look around the world, our yields are actually quite high. This chart shows the breakdown of developed market government bonds by yield, and the dark blue there shows that about 30% of governments around the world, developed market governments, are issuing debt with yields that are below 1%. And our yield, at the time this was taken, was 0.70%, was actually higher than 80% of developed market countries. So even though our yield is quite low, it's still attractive relative to what you can get in other developed markets at this time. So treasuries in the month of March performed very well as interest rates declined, but other areas of the fixed income market didn't fare so well. I stated earlier that the bond market had a lot of stress during the last month, and the shutdown stemming from the COVID-19 caused stress in the credit markets. But those stresses were really exacerbated by plummeting oil prices. Oil fell to $20 a barrel for the first time in 2 decades. There was a price war that erupted between Saudi Arabia and Russia in mid-March, which caused a lot of the stress in the oil markets and caused oil to actually go below the break-even price for U.S. shale producers. And so with oil trading below break-even prices and the debt of over-leveraged U.S. shale and oil producers became very toxic in March, leading to a cascade of selling in the credit markets, and high-yield bonds were hit especially hard given their higher allocation to energy names. So for the quarter, I want to show you what this looks like here. These are different returns of parts of the bond market year to date. Both high yield and emerging market bonds were down over 13%. Leveraged loans, the gray bar there, experienced double-digit losses as well, with losses of 11.31%. Investment grade global bonds fell marginally at negative 0.33%, while domestic investment grade bonds managed a small positive return of 3.15%. Again, most of that bolstered by very strong returns in U.S. Treasuries, given the flight to safety during the month of March. Overall, the markets have had a very rough start to 2020. And the big question on everybody's mind right now is how bad will the economic downturn get and what kind of recovery lies ahead? Well, there's no doubt that activity will suffer a very severe contraction in March and April. There will be a very severe contraction in global gross domestic product. There's going to be a very sharp rise in unemployment. But the good news, however, is that governments around the world have stepped up with a coordinated combination of fiscal and monetary policies to act as a bridge to help individuals and businesses weather the downturn and hopefully set the stage for a robust rebound. I'm not going to dive into all the details, but to just summarize it, saying that in the US, the Federal Reserve stepped in very quickly to decrease interest rates and to reestablish liquidity in the bond markets. And since their moves, we've seen a lot of improvement in the liquidity of bond markets, which has been very good for investors. On the fiscal side, the US passed the CARES Act, which was a $2 trillion stimulus package to aid in the recovery. And on the right-hand side of this chart, you can see some of the major points of this act. So it's $2.2 trillion act. And some of the things that are included are that people will get a one-time stimulus check amounting to $1,200 per adult and $500 per child up to certain income limits. They enhanced, expanded, and extended unemployment benefits, adding $600 per week to every unemployment check for 4 months. And they also expanded the program to cover contractors and self-employed and extended the length of unemployment benefits. They increased loans to distressed businesses in cities and airlines, gave small business relief in the form of forgivable loans, and gave direct aid to state and governments, along with other spending and tax breaks and health-related spending. So it was really a tremendous bill that was passed to help aid in this recovery. And on this news, the markets rallied for several straight sessions and notched the best 3-day return since 1931. So very quickly, what I saw was that investors went from panic selling to fear of missing out on the rebound. And so I wanted to address this for you and walk you through the usual anatomy of a bear market. So the question on everyone's mind is, well, did we already hit bottom since we've seen this tremendous rally after the passing of the CARES Act? And the interesting thing about bear markets is that during bear markets, it can often feel like you are on the wrong side of the trade because markets move wildly in one direction or another. So bear markets typically unfold with wide price swings marking the beginning stages. And there are often large relief rallies followed by what we call a retesting of the lows. And the range of the rallies and retests tend to tighten during the latter stages of the bear market as uncertainty begins to stabilize. And what this does is it allows the market to form a sound base from which to post a strong, sharp downtrend reversal. And what I wanted to do was look back on the S&P 500 index during the financial crisis of 2008, 2009 as an example. If you look back at other bear markets, you will see very similar price moves as well, but the financial crisis is probably the one that's most recent in your minds as well. So this chart shows the S&P 500 during several months of 2008 and 2009. And I know it may look overwhelming to some of you, but let's just look at this from a high level. So bear markets give many false positives that the worst is over because relief rallies occur, which are those 11% bounces shown above. As you can see from this chart, we had single day relief rallies of about 11% in October and November of 2008. And those relief rallies were soon followed by additional plunges in the market. But as the bear market continued, the trading ranges tightened up. So instead of seeing huge moves in the market on a daily basis, we saw smaller trading ranges of 3 to 4% until a very solid base was eventually formed. The market eventually bottomed on March 9th of 2009, and then a pronounced upward trend began. So it's easy to see here that if you had the fear of missing out and got back into the market in October or November 2008, you still had quite the downturn after that to stomach. So going back to this chart, this bear market has been characterized by very wild swings. There's still plenty of uncertainty, and the market, I believe, has not yet retested its low. You can see we hit a low on March 23rd of 2020. We rallied for those 3 days, which amounted to the strongest rally since 1931. And then since then, we've had a bit of a pullback again. And I would not be surprised if we retest that low over the next few weeks, as that is how bear markets typically unfold. You have these wild price swings, retesting of lows, things become a little bit more range bound in terms of the price moves. Eventually you establish a base and you go on from there. It doesn't mean that it has to work out that way. Certainly history doesn't always repeat itself, but if you are a student of bear markets, that is what you typically see occurring. So for those of you who are in our core satellite strategy, we are still in our risk off allocation, and we will wait for a more established base to be formed before getting back into the markets, because that helps us reduce the probability of buying after that relief rally, only to sell again a few days later. So overall, what do we see really going forward? Well, right now we don't yet know the full extent of the hit to company earnings and the contour that the recovery will take. And really this time is truly different. So there's no precedent for this, and thus no playbook for the global recession that's currently unfolding. Recessions are typically caused by the interplay between severe economic and or financial imbalances, but this time is very different because the underlying cause of the downturn is a truly exogenous shock that originated from outside the economic and financial sphere, a highly contagious virus that's rapidly spreading around the globe. And what we are witnessing right now is the first ever recession by government decree, a necessary temporary shutdown of economies around the world aimed at preventing an even larger humanitarian crisis. Now, on the good side, what is also different this time around is the unprecedented speed and size of the monetary and fiscal response to the crisis. Policymakers have been pulling out virtually all the stops in an attempt to keep the recession short-lived, and the response has been even greater than that of the global financial crisis of 2008, as many lessons were learned during that cycle. This policy response will very likely help prevent a global depression and support economic recovery once the restrictions on economic activity are lifted. And so overall, we expect that the global economy will transition from intense near-term pain during the virus suppression phase to gradual healing over the next 6 to 12 months once the spread of the coronavirus is under control and the restrictions are lifted. So I urge patience over the months ahead as this continues to develop over time. For those of you using our strategic portfolios, we recently rebalanced the portfolios on March 20th, which was 2 days before the most recent bottom, in order to take advantage of market dislocations. At that time, we also put a portion of the bond allocation in cash in order to provide additional liquidity to our clients during this time. And we will continue to assess the economic outlook and make changes to the portfolios as warranted. Thank you for your continued confidence.